Welcome to House Lux Estate, your trusted guide in the world of real estate investment. We're here to help you navigate the complex landscape of property portfolios, providing insights and strategies to maximize your returns. Today, we're focusing on a topic that's crucial to every investor: the role of asset allocation in risk management. This powerful tool can be the difference between a thriving investment and a struggling one. So, without further ado, let's delve into the intricacies of asset allocation and risk management. Firstly, let's unpack the concept of asset allocation. At its core, asset allocation is a strategy that involves dividing an investment portfolio among different asset categories such as stocks, bonds, and cash. The aim of this strategy? Well, it's all about balance. Imagine a tightrope walker. They don't place all their weight on one foot, do they? Similarly, in asset allocation, you don't put all your financial eggs in one basket. This brings us to the importance of a diversified portfolio. Think of it this way: if you're only invested in one type of asset and that market struggles, your entire portfolio takes a hit. But if you've spread your investments across a variety of assets, the poor performance of one can be offset by the strong performance of another. It's a little bit like having a safety net under that tightrope. Now, how does asset allocation help you achieve your financial goals? The answer lies in the balance between risk and reward. Different asset classes carry different levels of risk and potential returns. Bonds are generally considered lower risk but offer lower returns, while stocks are higher risk and potentially offer higher returns. By carefully selecting a mix of assets, you can tailor your portfolio to match your risk tolerance and financial goals. For example, if you're aiming for a higher return and are willing to accept more risk, you might have a higher proportion of stocks in your portfolio. On the other hand, if you're closer to retirement and want to protect your capital, you might lean more towards bonds. One key point to remember is that asset allocation isn't a one-and-done deal. It's a dynamic process that needs to be reviewed and adjusted over time. This could be due to changes in your personal circumstances, market conditions, or financial goals. In conclusion, asset allocation is more than just a strategy. It's a fundamental part of intelligent investing. It's about maintaining balance, managing risk, and ultimately helping you to reach your financial goals. Asset allocation is a dynamic process, and it plays a crucial role in determining the returns on your investments. Now that we understand asset allocation, let's explore risk management. Risk management, quite simply, is the practice of identifying, assessing, and controlling threats to an organization's capital and earnings. In the context of investing, these threats or risks could range from fluctuations in the stock market to changes in interest rates or even geopolitical upheavals. Why is risk management important? Well, it's all about balance and protection. Imagine you're a tightrope walker. You wouldn't just run across the rope without a safety net beneath you, right? In the same way, investors need a safety net to protect their investments. This is where risk management comes in. It serves as a safety net for investors, helping them mitigate losses. It's not about avoiding risk altogether. That's impossible. Instead, it's about understanding these risks, managing them effectively, and turning them into opportunities for growth. Now, how does risk management tie into asset allocation? Picture a jigsaw puzzle. Each piece of the puzzle represents a different type of investment, like stocks, bonds, or real estate. The way you arrange these pieces or allocate your assets can greatly influence the overall risk of your investment portfolio. For instance, if you put all your money into one type of investment, say stocks, and the stock market crashes, your entire portfolio takes a hit. But if you spread your investments across a variety of asset classes, the losses in one area could be offset by gains in another. This is the essence of diversification, a key component of both risk management and asset allocation. In a nutshell, risk management helps investors make informed decisions about where to put their money. It helps them strike a balance between risk and reward, ensuring that they don't put all their eggs in one basket. Risk management and asset allocation go hand in hand in creating a successful investment strategy. So, as you navigate your investment journey, remember, manage your risks wisely, diversify your portfolio, and let asset allocation be your guiding star. Now comes the question: how does asset allocation act as a tool for risk management? In our journey through finance and investment, we've understood the concepts of asset allocation and risk management. Now, let's delve deeper into how these two concepts intertwine. Asset allocation, at its core, is a strategy to balance risk and reward by apportioning a portfolio's assets according to one's goals, risk tolerance, and investment horizon. In simpler terms, it's about not putting all your eggs in one basket. This is where asset allocation shines as a tool for risk management. Imagine you're an investor. You have your money spread across bonds, stocks, and real estate. If the stock market takes a hit, you're not left in the lurch because your other assets, such as bonds and real estate, could potentially still be performing well. This is the power of asset allocation. It can cushion the impact of potential losses from one asset class by spreading the risk across multiple asset classes. Let's look at another example. Suppose you're nearing retirement. You might want to adjust your asset allocation to be more conservative, focusing on income and preservation of capital rather than growth. This could mean shifting a larger portion of your portfolio into bonds and other relatively stable assets, thus reducing the risk of a significant loss that could impact your retirement plans. Asset allocation can also be dynamic, adjusting based on market conditions. For instance, during a bull market, you might allocate more to stocks to take advantage of the upward trend. Conversely, in a bear market, you may shift towards bonds or other lower-risk assets. This tactical asset allocation can help manage risk and potentially enhance returns. However, it's important to remember that asset allocation doesn't eliminate risk entirely. It helps manage the risk-reward trade-off based on your individual circumstances and investment objectives. It's also not a one-time exercise. Regularly reviewing and rebalancing your portfolio is crucial to ensure it aligns with your changing goals and market conditions. So, in essence, asset allocation is a proactive approach to managing risk. By diversifying investments across different asset classes, adjusting the allocation based on your goals and market conditions, you can mitigate the impact of market volatility, safeguard your investments, and potentially achieve better returns. Strategic asset allocation can significantly reduce risk and increase the potential for higher returns. Let's recap what we've learned today about asset allocation and risk management. We've delved into the world of asset allocation, understanding it as the strategic distribution of investments across various asset classes, such as stocks, bonds, real estate, and cash. This isn't a one-size-fits-all approach, but rather an individualized strategy that takes into account your financial goals, risk tolerance, and investment horizon. We've also unraveled the complex subject of risk management. It's not just about avoiding risk, but rather managing it effectively. This involves identifying potential risks, assessing their impact, and implementing strategies to mitigate them. In the world of investments, risk is inevitable, but managing it can be the difference between financial success and failure. When we brought these two concepts together, we saw how asset allocation serves as a powerful tool for risk management. By diversifying your investments across various asset classes, you can spread the risk and potentially enhance returns. Remember, it's not about putting all your eggs in one basket, but rather spreading them out to mitigate potential losses. While asset allocation provides a strong foundation, it's not a set-and-forget strategy. Regular rebalancing is crucial to ensure your portfolio remains aligned with your investment goals and risk tolerance. This means periodically buying or selling assets to maintain your desired asset allocation. It's also worth noting that while asset allocation and risk management are critical, they're not the only factors to consider in your investment journey. Other elements, such as your personal financial goals, market conditions, and your own comfort with risk, also play a significant role. In closing, asset allocation and risk management are two fundamental aspects of a successful investment strategy. They allow you to balance risk and return, and can provide a roadmap to achieving your financial objectives. Remember, understanding and implementing asset allocation and risk management can make a significant difference in your investment journey. And that's a wrap on today's topic, asset allocation and its role in risk management. We've explored the nuances of this complex yet essential strategy, which is key to ensuring a well-balanced and risk-managed investment portfolio. We hope this discussion has been enlightening and has given you a fresh perspective on how to navigate the world of real estate investing. We value your thoughts and would love to hear your insights, experiences, or questions about asset allocation and risk management. Feel free to share them in the comments section below. We believe that learning is a community endeavor, and your participation enriches this platform tremendously. For more insightful content on real estate investing and related topics, remember to subscribe to our channel. We regularly update our feed with fresh, relevant, and exciting content designed to empower you in your investment journey. This is House Lux Estate, your trusted guide to real estate investing. Don't forget to subscribe, and we'll see you in our next video.